Peter Rose, Longwood Currency Trading. I changed my mind from doing this video inside to coming outside. And why? Well, because I wanted to come out and show you these. Our spring changes that are happening right now. And you know what? If I can change my mind to come out instead of doing the video inside to doing it here, then I can change my mind when I'm doing a trade as well, or during a trade, or after a trade, or whatever. And this is all generated by some comments. I don't get a whole lot of emails because not very many people have discovered the channel yet at this part, even though this is my 98th or 99th video. The couple of times that I've received some responses from videos that I've done has been, there seems to be a conflict or a contradiction. As one time you'll say that you did this, but then that appears to be a methodology or a system. That in the next video you'll say that you did something else. And that's true. It's called changing your mind. I'm not changing my mind about the way that I trade. I change my mind about the way that I implement a trade at any particular time based on the conditions. Perfect example of that, and this is a little different than the topic, but I've talked a lot because I'm a day trader and I'm on a 5-minute chart with basically what is or has been for a while, a 5-period ATR. I can take that 8-pip hard stop position and just get out because I'm wrong. And a lot of people will say, well, you don't give the price time to breathe, and you cut the trade short. And I've gone over that in ad infinitum on detail as to why I do that. And yet on another video I'll say, gee, I let this trade run, and it ran so far that I decided I would change the time frames, and instead of doing a day trade, I'll do a carry trade. I'll do a longer term trade. I'll look for a longer term profit target. And when I do that, usually what happens is I get very upside down on my reward to risk ratio. In other words, I end up on paper during the position as it matures through, that position goes into far more loss than the ultimate profit that I get out of the trade. And so that becomes an issue for some folks that look at that and they don't really understand what I'm doing, and then say, well, you're crazy because you're violating reward to risk ratio, and you've talked about reward to risk ratio. Well, I only talk about reward to risk ratio because everybody else does as well, and there's some validity to that, particularly when you're beginning to learn how to trade. But as a whole, a holistic view of the trading process, I don't believe in the reward to risk ratio at all. I don't think it has any significance with the market. It doesn't make any sense to me, but that's just me. So I don't mind taking a 4-time risk or a loss. Let's not even talk about risk, because I don't set those risk things like that. Suffering a 4-time risk, call it a risk, a 4-time, it's really a loss during an open position, to ultimately taking 1/4 of that as the ultimate amount of profit that I take. And the reason for that is I made a decision, because primarily I'm a day trader. I made a decision at that 5-minute chart level that I had a pretty good idea for a 10-pip run or a 20-pip profit. I don't really make a trade unless I've got 20 pips. There's got to be 20 pips there, because then I'm I have a 70%, 80% statistical probability that I'll get 5 to 10 pips out of it. And look, if I can make 5 pips every time I trade, I'm going to do fine. And I've gone through the math on all that. So if I'm looking at that win of 10 pips, and it starts to go against me, and I'm convinced that I'm right, and I've gotten in more trouble being convinced that I'm right than you can shake a stick at. So don't point your finger at me and say I'm talking out of the side of my face. We're all going to do this. You just have to figure out a way to get out of it. There's 2 ways to get out of it. You close the trade. Even though it's a big loss, you close the trade. The other way you get out of it is you change the time frame, because you figure that in the long term you're going to be correct. Now, you don't know when that's going to happen, so therefore you can't quantify the amount of loss that you're going to suffer while that position continues to run as an open position. But you have identified a probabilistic expectation of a gain. That gain is not proportional to the loss that you're going to suffer along the way. You just have to accept that. You know, a guy that's a competitive power lifter is going to suffer far more harm to his body and tearing apart of muscles than he's going to gain anything by winning a silver trophy and $5,000. It's the gain that you look for. Too often, and you know, you can look at me and say, well, you lost all this money and you do this and you're just farting around and blah, blah, blah. Look, I'm far more bright than that. I'm not in this to end up losing money. I'm not in it to win a little bit of money. I'm in it to win a lot of money. And I'm going to do that by looking at the law of large numbers and the probabilistic expectations of gains. And sometimes the percent is the thing that you want to think about. The percent gain is what you want to think about. And on other times, it's the dollar amount that you win. If you have let's take big numbers, because you know you can look at I usually give all my examples trading a mini lot, because most folks out there are just, you know, they're trading mini lots, and you can think in terms of a $10 win or a $20 win, but in the big picture of things, 20 bucks is a pizza. I've done videos on that. So let's look at the real world where we're trying to get to. I mean, I have a 6-figure account. I don't have 6 figures in my trading account. I've got a larger than just 6-figure bank, but I haven't put it into my trading account. I have a significant amount of money in the trading account, so I can postulate what a 10-lot trade would be or whatever. But let's just be moderately realistic with what a professional trader would have in their bank in order to make a significant amount of money that it would impact their daily life. And I think a $50,000 account is a pretty fair size account. It's not a 6-figure account that some of us can have, but it's a significant amount of money. So let's look at that $50,000. It means you can trade 5 fulls, 50 bucks a pip. So let's say you've got a 10 pip profit target. That's a $500 profit target, and you take an 8 pip loss. You know, it's a you're out of balance risk reward. So well, you know, you're pretty close to 1-to-1, but that really doesn't make any difference. Regardless of the fact is you're looking for that 10 pip run, whether you're trading 5 minis or 5 full. Doesn't make any difference. It's $5, 50 bucks times a pip. So you make 10 pips, you make 50 bucks a pip, you're making 500 bucks, right? Let's say your risk is equivalent to that. Your stop is at 10 pips, so you're going to take a $500 loss or a 10 pip loss, same as what your gain is going to be. but it starts going against you. But you've got a really good long-term view that the price is going up, and now it's going down against you. I mean, you took a long trade. You're in it for the long run, and it's not going against you. And you've got this 10 pip stop, and it's approaching that 10 pip stop, and you go, wait a minute now, this is not right. I'm looking at the fundamentals, I'm looking at the long-term stuff here, I'm looking at everything that we look at when we evaluate a position. You can't just say one thing. If I can short MA, cross that long MA, and so I'm good to go. You don't paint the side of a house by just saying, there's the house and I'm going to paint it. Well, how dirty is it? How much cleaning am I going to have to do? What are the nooks and crannies? How much paint am I going to have to use to cover this part? As opposed to, I mean, there's a lot of things that go into making a trade decision than just making some dumbass simple rule calculation. So I made my rule calculation. I said I've got a good, strong likelihood of a 20 pip run. I'd be happy with the 10 pips. I've got a 10 pip stop. The thing is going against me. It's 8 pips against me. And I'm looking at this situation, and I'm seeing that though I've made my positional judgments based on the current short frame structure, I have stronger frame structures further out, maybe on the 1 hour or the 4 hour charts. And so let's change my view of the market at this particular time to be one at 4 hour. So now that profit target that was originally 20, that I'm accepting the 10, might now go to 40 as a potential, with a 20 pip realistic profit target based on structure. And obviously, I mean, it could be more than that. I'm just pulling numbers here. I don't know. Let's make it a 50 pip profit target, and you can get a 25 pip realistic structural point. Well, now that 10 pip stop that I'm currently rapidly approaching doesn't make any sense, so I pull it, and the price runs. Have I violated the rules? Yes, I have violated rules. Whose rules? I don't know, some dumbass that's sitting up there trying to teach you how to trade that doesn't really fucking know what they're doing. And I've said I've got an 8 pip hard stop, so I'm violating that. I've changed my mind. I haven't changed my mind about the overall rule to have the stop. I've changed my mind about when to apply that stop. And in this particular instance, even though I'm long biased and the trade is running heavily against me, I'm now 20 pips down. I'm now 30 pips down. Should I change my mind again? No, because I've changed it once. The only other change that you can make is get out, because you're really wrong. So you constantly are evaluating that position as it's running. That's why I believe that you can't do this stuff and walk away from the trade. I mean, from a long-term trade standpoint, you know, it makes you ill, because once you walk away from that trade, you have to set your profit. You have to set a hard profit target, and you have to set a hard stop, because you won't be there to manage it. You won't be there to make a decision. And so if that thing runs and it goes to your profit, and I've had this happen. I've had that thing turn around and run and hit my profit target and run 150 pips more. And if I would have been there, I could have trailed behind it. And if the bear wouldn't have stopped the shit in the woods, the hunter would have never seen him to shoot him. You can't if yourself to death. So we're looking at this situation where I've looked holistically at the current price action, and I've decided to go from a 20 pip profit target with a 10 pip acceptance to a 50 pip profit target, 25 pip acceptance. I've removed my stop at the 10 pip level. Where do I put my stop now? It doesn't matter, because I'm managing the trade. I'm not going to put a stop there, because I've gone to a long-term time frame. And by doing that, what I'm saying is that in the long term, the price should, with a high probability, turn around from going down and return back up or regress to the mean or whatever it's going to do and go back in the direction that the trade was supposed to go in. And because I was right in the first place on the 10 or 20 pip profit target, I've now expanded that to a 25 pip, a 50, 25 pip expectation. What am I going to do in order to achieve that 50 pip profit? How far do I let it run against me before I say I've had enough? In my personal trading, I just let it go. Now, I've often characterized that as incorrect. And it's only incorrect because I don't want to be a carry trader. I don't want to be a long-term trader. I don't even want to be a trader that has to sit there for 8 hours. I want to be a trader that in 2 hours I'm done for my day. If I choose to trade again, I want to be damn sure that I'm not going to give all that money back. So in choosing to change my mind from a short-term time frame, I'm not changing my mind about the direction of the trade and my profit. I'm changing my mind about how long I'm going to hold the trade. Now, I don't know how far it's going to go against me before it turns around to get to my profit target. The further it goes against me and the more money that I lose, the more willing I am to accept less profit because it's gotten so far away from that extended profit area that it's going to take a tremendous amount more time to retract itself and to come back. And so I don't know how far it's going to go before it turns around, but I have to have confidence and faith that it will turn around because of everything that I know about the trading process. Now, I've had 2 times in my life when I've gone to margin and been wiped out by doing that. That's the danger in doing it. And I've done another video where I talked about this. Now, most folks wouldn't let it go to margin. They'd have a panic stop. They'd have a pain point. To me, because I have sufficient money to refund the account or to keep going, and I don't bet all my balls on a one trade, I'm not willing to cut that loss at any level because I have confidence that it will turn around. I just don't want to put myself in that position in the event that I'm wrong, because 2 times in my life I have been wrong and it's flatlined my account. I've gone right to the wood. If I go to the wood, it doesn't mean my trading days are over. It means I have to replace whatever amount of money that I have in that account that I went to the wood with an equivalent amount of money. So if I go to the wood with a $10,000 account, I better have another $10,000. If I go to the wood with a $50,000 account, I better have another $50,000 to put in there. That's money management. It has nothing to do with risk management. I'm not breaking any rules. I just have to be sure that I've got enough dry powder that I can continue to play the game. Warren Buffett said there's only 2 rules to investing. Don't lose money, and rule number 2, see rule number 1. What he really means is not don't lose money. Don't lose all your money, because when you lose all your money, you can't play the game. The greatest investors in the world have gone broke in their initial days of learning how to trade. Going broke is not anything to be ashamed of. What the crap? If you're a competitive wrestler, you're going to lose, and you're going to lose many, 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 many times before you start to win. Competitive sailor, a basketball player, anytime. I mean, if you've never done a sport before and you're sitting there, your fat ass in a chair, you can argue with me all you want, but you know that you're going to lose. In anything that you do, you're going to lose, and you're going to lose a lot, and you're going to lose a lot of times before you finally figure out what to do. And if you have the innate skill to rise above to that 20% of the competitors, or the 4% of the competitors that are successful, 80% are going to fail. Just the general 80-20 rule. Right? 80% are going to fail, 20% are going to succeed. 20% of that 20% or 4% are going to be really successful. And 20% of that 20% of that 20%, the 1%, that's the Beethovens, or the, well, not even the Beethovens, probably 20% of that. So here I'm sitting with this position with an open-ended loss potential, which would basically be taking into account of the wood, with a finite profit target that the further the risk goes away from me, the smaller the profit target goes. And these are based on percentage things. All right, so let's say price, I'm dealing with a 5 lot. So it's 50 bucks a pip, and I go 200 pips against me, and I've got a 25, or I got a 50 pip profit target. I've gone 4-1 against me. I'm $10,000 down on a bet to hit the 50 profit target, and which is now 20 pips, which is $1,000. So I'm now only going to make, if it turns around, 10% on the money that I've experienced during the loss. That's a 10 risk against you, if you believe in risk to reward. But here's the difference. You make $1,000. You make $1,000 on the 50. What is that? That's a pretty good percent, but it's not a big percent in relationship to what you've lost, right? Well, it's the same percent, I guess. But it's $1,000. You've increased your bank by $1,000 or $500. So, in one instance, when we're trading, we're talking about trading by the pips and trading by percentage and taking the dollar value out. But at the end of the day, you're not trading for pips. Pips ain't going to buy you a pair of shoes or a good bottle of wine. It's the cash that enables you to buy that bottle of wine. And that's what you're in the game for. And you got to remember, in all this stuff, you have to have faith in your ability to be a good trader, that in the long run, everything is going to work out. So yeah, you had a 50, you started with a 20 pip profit target, and that didn't work out. And then you went to a 50 pip profit target, and you had to reduce that and all that. But you did that in a day. You made $1,000 in a day on a $50,000 account. Or let's say you made $500. You made, 1%. You make $500 in a day. Let's say you make $250, 0.5%. It's $250. That's the key. I made $250 in a day. That's a good wage. So, have I been an idiot, a moron, a fucking dope to have gone $10,000 in open losses to make $250? I don't think so. Now, let's say that I failed and I had to close that account out because I lost, let's say I took a $20,000 loss. I'm tired of this. I got, too much. Take $20,000. So now I refund the account with another $50,000 because that's the criteria you have to have. whatever amount of money that you have in your trading bank, you better have that as backup, or you shouldn't be in there, because now you're trading with a short stack, and you can't ever do that. So now what happens? Now I've got a $50,000 bank again at 50 bucks a point. If I make $100 a day, every day, for the 20 days a week that I'm trading, I mean, $100 a day. Think about this. Make $100 a day on that $50,000. I'm not talking about percentage gains, or is that worth the effort, or I don't give a shit about any of that stuff. It's just $100 on 50. But you're making $100, and you do that 20 days. That's $2,000 for the month, right? If you did that averaged out, some days you make $2,000, some days you lose $4,000. But you make $100. You make $2,000 a month. Well, you then make the $20,000 that you lost up in 10 months. Now you've got the other 12, and you're $4,000 ahead on your $50,000 account. How you doing? You're almost 10% on your money. About 8% on your money for the year. And you took a $20,000 loss one time because you got it wrong. You cannot be afraid to change your mind in the middle of a trade. You have to be able to be dynamic. You cannot be trapped in your rules. I just did a video last week or the week before on rules are not static. You can't have static rules. You have to be able to change your mind. The only reason people talk about static rules and you got to follow the rules is they don't fucking know how to trade. And they know you don't know how to trade. And so they give you these static things that you can clutch onto. Oh, I'm going to take an 8-pip hard stop. Oh, I'm going to, when the short MA crosses the long MA, I'm going to do this. When the Bollinger Bands do this, or when the RSI does this, it's all bullshit. You never trade that way. You can't. You have to trade based on your experience. And if you don't have any experience, then you're going to fail. The only way you're going to learn is to lose money, to figure out what works. That's what Jesse Livermore said. Everybody said he was a cowboy. I think he's won something, and don't quote me on this, it could have been 4 fortunes or it could have been 7, I don't know what it is. But he lost, let's say 5 fortunes in his life. But he made 5 fortunes, and each one of those fortunes was more than what some of the wealthiest people in the United States today are worth. He had a 30-year career or whatever it is. He did 5 of those in his career. One time, he made the equivalent during the stock market crash of 1929. He made the equivalent today of $1 billion. He's the greatest trader that ever was. Now, how can you lose $1 billion? But he did. He lost all that money. He bought a fucking yacht, and he paid everybody all kinds of money, and he drank like crazy. And I don't know what the hell. How do you go through $1 billion? But he did. I think he traded and lost it too. And he died broke. And everybody said, see, where did that get him? He died broke. Yeah, but what a life. What are we here for? Are we here to keep the boat in the harbor? Or are we here to take that boat out and experience the joy of sailing and being out on the water? Well, that's your choice. Yeah, it could be a tough choice to make, but it is your choice. And so, if you start out trading, you need some very specific rules in order to trade, but that's not going to keep you from losing. That's going to get you to learn. So you need to be sure that you have studied from someone who has a good set of rules that lead you to the point where you understand, or that person can show you how to change those rules, just the way that I just went through that little example scenario for you, how you need to be able to change your mind. And by doing that process with a small bank when you start, you'll learn how to trade and you'll be okay. You'll be successful. You won't make the mistakes that I did by getting in there with a large bank to start with an unproven set of rules in the real market conditions. I believed all the shit all these people were telling me. Very good people. Oh, trade in a simulated account. Learn to trade in a simulated account. And then, you know, when you get your processes down with your Bollinger Bands and all that other crap, then you can go out and fund your large account and go away. And the simulated accounts, all these companies can give you $50,000 of play money. Well, you know, if you're not going to come to the table with $50,000, why trade in a simulated account with $50,000? I traded in a simulated account with $40,000 because that was the amount of money that I was going to have to fund my live account, because I believed all these assholes that were telling me that I could learn how to trade in the simulated account. I didn't have somebody like me explaining how things are really done. God. And so I lost 40. And it's taken a long time to go back through all of the study and stuff that I did to determine where the bullshit was. And it's just, this is early April of 2021. So it's just the first of this year that I've begun to dribble a little bit more money into my account. And then after I sold my last building, I was able to have the large financial assets behind me that I can trade with a 3-lot with no problem. And I've got the 3-lot, the $30,000. I've got another 30. I've got 100 more. I can do this. But I'm not going to be successful by following static rules without being able to change my mind. But I need to know that if I'm going to change my mind, that everything is going to work out. Even when I do something stupid, like I always point to Ed on my shoulder here, the little bridge troll that whispers in my ear to do stupid shit. That's the only thing that I have to worry about, is listening to Ed. Because I have my rules down. If things are going against me, I just need to get out. I need to sit it out. Because if I take an 8 or a 10 pip loss, I'm not going to let this shit run. That's not my way of trading. I take that short loss. Let's say it's a 10 pip loss. I'm trading with a $30,000 account. Say, so I'm trading at $30 a pip. So let's say I take a 10 pip loss. I lose $300, right? Well, that hurts. Well, that hurts because it's $300, but I got to get that out of my head. It's 10 pips. I'm shooting for 20 and I'm taking a 10 pip risk. So I lose once, I lose twice, and I win 3 times. How am I doing? I'm ahead of the game. So that's what I have to keep in contrast. Why should I let that thing run to 100 or 200 pips against me so that I can grab $1,000 or $250? Yes, I've made the money, and I have to look at that as I just entered the trade. I took the trade, it went in my favor a little bit, and I decided things were not working out too well, and I got out. Wouldn't I be happy with $250 with that? Yeah, so I could block out the fact that I was $10,000 down at one point. The only thing that's bad about that is that $10,000 down could very easily become 20. And those are significant amounts of money. So if you're going to take a running loss, be sure that if the heat becomes too much and you need to shut it down, that you've got that much money in reserve to bring back into your account to make yourself whole. Because then you'll be able to run that money and have a decent return at the end of the year, as I just identified for you. You're not going to light the world on fire, doubling your account, but at least you'll come out okay. Far better from a percentage standpoint, believe me, than you would if you were risking your money in real estate. God, friends of mine are crushed today in the real estate that they own. Not only some of the commercial guys, but just the guys that were doing what I was doing, which had this 4-unit apartment buildings. You know, their tenants are out of work, they're sick, they can't pay the rent, but the mortgages still due. So there's a mortgage forbearance, there's tenant forbearance, everybody's forbearance until somebody stops the music, and then somebody's going to have to pay. The tenants aren't going to pay you. They're going to go, oh, you want me to pay all my back rent, or you want me to start paying rent now? I don't think so. I'm going to move. So they're going to leave, and they're going to go to some other person whose their tenants have left. So of course they're going to take that tenant in. It's just going to be a chair swap. You're never going to be able to make that money back. Of course, your rents are finite. The number of buildings that you have is finite. It's a very tough situation right now. In currency trading, cripe sakes, you just have to make sure you got cash. You lose, put some cash back in and go back. What would you do if you were playing poker and you went to the wood? You don't play with your whole bank. You don't risk the ability for your family to survive. You take a really bad hit, you go home, you go to the bank, you pull some money out, and you go back to the tables the next day and you play again, because you know that in the long run you'll make that money back. When you're starting to learn how to trade, you don't know that you're going to have the skill to make the money back. You have to have faith that you will be able to learn how to do that, but you need to get the correct guidance in order to be able to differentiate between when you follow a hard rule and when you can change your mind. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.